Hey everybody, Matt McCall here. Good afternoon, buenos tardes, whatever language you speak. Thanks for joining me on likely your lunch break or pre-lunch, maybe your morning break. Jumping in here, maybe you're still having coffee with me. But I thought it was important to jump on today, this week in particular, to do a live event based on what happened over the weekend. Obviously, unless you've been sleeping under a rock, we are at war with Iran and it's spreading throughout the Middle East. Other countries involved, maybe not want to be involved, but they are, and it's something that's we need to focus on as far as investing, both here in the short term and the long term. And when there's times like this, there's a lot of uncertainty in the short term. Call it chaos, which often leads to great long-term opportunities. And I'm not going to sit here and be like, oh, all we're going to talk about is opportunity and buying today, everything. I'm not saying that. We're going to take a look at the facts of what's happened in the past in similar situations, take a look at some of the charts and where certain sectors have been moving, talk about some individual stocks that I like, and then obviously take your questions at the same time. So let's just jump right into it, though. I want to get into this right now. And at this point, I think there's nothing more that we can do than to just looking at what's going on with the markets. And as you can see, I named this "Markets Love War," and here's why. And I know it's a bit controversial because I don't think anybody loves war outside defense contractors potentially and some lunatics who tend to run the world. So yeah, I guess some people do, but I think the majority do not love war. Um, but as I mentioned, if you don't know who I am, I'm Matt McCall, entrepreneur, investor. I've been doing it for a long time, over 25 years. I had a couple of best-selling books. I used to be a host on Fox Business with Charles Payne for many years. I have over 50 stocks that have had 1,000% gains, and I've been doing this a long time, and I love it. And it's something that I think is extremely important that everybody invests at some point. You work very hard for your money, so you should be investing in your future along the way. Now, the current landscape, as I just mentioned, chaos, uncertainty. That's where we lie right now. There is this chaos of we're at war. I mean, I'm going to talk about this throughout today. I don't think we're on the cusp of a World War III. I don't think we're near a World War III potentially, but I do know there's still chaos out there, and it's affecting different people in different ways. Then that leads to uncertainty. Even if you're not affected by this directly or even indirectly, there's an uncertain feeling of where the world's at right now, where the geopolitical situation's at, where politics is at, where money's at, where the market's at, where stocks are at, where crypto's at, everything. There's an uncertainty overlying almost every thought process we have right now in life. So that then does create, believe it or not, opportunity, because with uncertainty and chaos comes emotional decisions, that leads to very poor decisions, and poor decisions lead to opportunities for those on the other side. So two things we want to achieve here today. Keep away from the emotional poor decisions. When I managed money for 17 years, that was the number one thing that I focused on, was helping people keep their emotions out of long-term investing. Because situations like this, or COVID pandemic, the flash crash 12, 13 years ago, how long it's been now, all retail people were spooked and selling a lot of them into the lows, and that being the lowest that we've seen since that time. So we need to kind of sometimes take the contrarian opposite view, but we're here, number one, to get the emotions down. That's number one. Two, look for opportunity. And then three, leading into the McCall letter, which is our front entry level stock research letter, because we're here to help you and guide you through these times. So let's take a look at the market update. As you can see, there's been this ripple effect from Iran, as many of us already know. Oil going up. I'll show a chart of oil and talk more in depth about oil in a second. Stocks, believe it or not, are holding up pretty well. And as I mentioned earlier, I don't think we're pointing towards a World War III. So stocks are actually holding up decently. The S&P, as of last check, is down about 6.6% on the day, down less than 2% from an all-time closing high. If we were heading into World War III or a really terrible scenario, we wouldn't have stocks sitting 2% from an all-time high. So, but the support of the underlying markets have been led by energy. Obviously, again, we'll talk about that in a minute. When we have oil breaking out to a year high, you're going to push energy stocks higher. The Mag 7 have been holding up better than the peers. That's the Magnificent Seven, the big stocks over $1 trillion market cap. And then we have the financials. The financials have been holding up, but just as of late, they are starting to break down. So the financials are breaking down a little bit here. Again, we'll show you charts of all these here in a moment. The worst performers, one might surprise you, is gold miners. Gold is typically the place people run during war times. Gold hasn't been that area. It's actually down. It's performing worse than the S&P 500 since last week. Housing's fallen because the 10-year yield, we'll talk about that in a minute as well, hitting highest level we've seen in over a month, spiking on this. And then we obviously see consumer staples, again, an area you think would do well, because in times of uncertainty and chaos and the unknowns, staples are the things we need. You know, with the toilet papers and this food and that stuff, the Walmarts of the world that sell all the staples to us. You know, you think that's money be going there because that's the safe haven. It's not. So we're in a very odd situation, which means it's like chaos. There's no rhyme or reason to really what's going on in the market. With the US dollar hitting a 2-month high, no big surprise there. As I mentioned, bonds a moment ago, the 10 years back at 4.14%. It was down below 4 just a week and a half ago for the first time in months. Now we're back above 4, spiked up. When bond yields go up, remember, that means bond prices are falling. People are selling bonds. Again, if you thought the world was going to World War III, you'd be buying bonds, not selling bonds. You'd be buying what are perceived as safer than equities. And it's not happening. There are some niche sectors that are doing all right. Some of the rare earths, antimony, which is a mineral that is used for a lot of weapons and defense. And some of the stocks that are holding up pretty well are the 4 mentioned right there. Shipping rates, because the Straits of Hormuz is basically shut down. You're seeing shipping rates go up. So shipping stocks, BWET actually tracks shipping rates, very volatile. I talked about this on a podcast a few weeks ago. It's gone up almost 100% since I talked about it. Then there's BOAT, BOAT, which is a shipping ETF with shipping companies. Again, we'll look at all these on the charts in a moment. Just want to cover the overall market. And again, if you're looking at asking questions, please put them over there. I'll look it throughout. Somebody made a comment that dollar strength is pushing gold down. Sure, you can make a case for that. In the near term, from day to day, I don't think that really has a direct effect on it, honestly. Longer term, I think it does. It just shows right now that people aren't viewing gold as that opportunity because it has run up so much. And I just don't think you're seeing gold. Typically, before times of uncertainty like this, you won't see gold going parabolic as it has. So it's not as much a safe haven because it's at such a high value, in my opinion. All right. So if you're worried, a few areas I think you should look. One is energy and oil stocks, the XLE. One's defensive stocks, and the PPA tracks that. Cybersecurity, those stocks have been doing very well. Precious metals, I still think, is a good area, for this to consider. And as I mentioned, shipping in a couple ETFs that track that. Now, here's WTI. This is West Texas Intermediate Crude Oil. That's what we see quoted here in the United States. And WTI here, I can see 78. It just most recently came within a couple pennies of $80 a barrel. And keep in mind, looking at this chart, to start the year, we were down in the mid-50s. So we've had a hell of a run since then, from the mid-50s up to just below 80 right now. And that's a breakout above the spike we had at the end of 2025. This chart's going back to 2022, so it's a longer-term chart. But what you see here, folks, we've had a downtrend going back for the past few years, a series of lower highs. That's now been broken. So this could be set up for a longer-term rally in oil prices, which, again, will be beneficiary to energy stocks, even though a lot of them have run up already. We saw a lot of buy the rumor, sell the news. We saw a lot of energy stocks go up, and people actually sell into the bounce on Monday, Tuesday, because they realize that these stocks, maybe these oil prices don't stay up here. Maybe these stocks are now at the level that they're not as attractive. So it's not your typical market right now. So what is the importance of Iran? Well, I'll tell you, it's the 5th largest oil producing country out there, about 5.1 million barrels per day, about 1/4 of the U.S. They're just over 20, about half of both Russia and Saudi Arabia, and just below Canada, but above Iraq and China and UAE, Brazil, Kuwait. So it's still very significant, but it's more significant to China because 90% of Iran's oil was going to China. Remember what happened in Venezuela not too long ago? 70% of Venezuela oil is going to China. China's now in a hole by about 2 million barrels per day. This is important. This is really, really important to realize this, that if you're looking at why maybe this is happening at this time, pressure on China, just keep this in mind, because China wants this to end quickly, because they are going to be in trouble because their prices are going to go through the roof for energy. So something to keep an eye on. If you see China start kind of bending and pushing Iran to kind of get out of this, I think that might be when we see the war come to an end. So when oil does spike, here's some sectors that tend to do well. As you can see here, relative monthly returns for sectors versus the S&P 500 during oil spikes. No surprise on the left-hand side here. Energy is the best, 1.9. Utilities, real estate do well. Communications, consumer discretionary, and financials fall. And again, do what you will with this. But what's interesting is communications so far this week, the communications ETF, one of the best performers. So again, we're not seeing this kind of follow the traditional pattern that you would see after a situation of war. So buy or sell energy stocks. And this shows different events going back to 1988, Praying Mantis, Operation Desert Storm. We see the strikes on the Houthis back in January 2024. It shows the one-day change of energy stocks. And outside of Operation Desert Storm, I can see it. All of them went up, for the most part, except for one that was flat. But you look 30 days later, these are energy stocks, folks. Down, down, up, down. Most of the time you'll get an average that's actually down. So you have that initial spike and then energy stocks come back. I've had energy stocks for a while. I liked energy stocks prior to what happened here. And we'll talk about a portfolio I just released about 2 weeks ago called the New Energy Portfolio, which is actually holding up really well. And I'll share a stock with you. So here's the markets after war. So S&P performance 12 months after a major conflict, index to 100 here for the S&P. Going back to World War II, goal forward, you can see down below, all the times 1 year later. So war, again, markets like it. I don't want to be controversial because nobody likes war. I don't want to see war, but markets do like it. And we can't ignore that fact. We can't rush out of stocks because of that, because we'll be missing out on potentially, again, a great opportunity to make money. So to me, the market's setting up for a really big move. And the reason for that is we started the year with the S&P 500 trading in the tightest range ever. You can see here, this is through January and February. Obviously, we're a couple of days into March now. But the range between a high and the low in the S&P 500 is 2.7%. The lowest in history ever. Going back nearly a century, nearly 100 years. The narrowest ever. So what does that tell me? It's like a spring, coiled spring. You go like this, tighter, 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 is narrower. And when it does, and the longer it stays like that, the bigger the next move will be. Odds are the move would be higher because it usually continues the prior trend, but it could be down. There's a good odds it could be down too, especially, who knows what could potentially happen and what's going on in the Middle East right now. If it spreads, it makes its way over to this hemisphere. That's obviously going to be a huge deal. So there's a lot that could happen. The war could also be over tomorrow. I don't know. I don't think anybody knows at this point. If you say you do, you're probably kidding yourself and lying to yourself. So setting up for a big move because we've been such a narrow trading range. And if we take a look, March is historically, we start March very ugly, then we start a rally. So maybe we're setting up for that. This is the last 20 years. And on average, the market closes up 10.4% in the last 20 years. So to just kind of get on top of why I think this could be a break to the upside, this is the S&P 500 customer put. And by buying puts, it means you're buying insurance protection against your portfolio, and you make money when the market goes down. So you're betting on the market to go lower by buying a put. This goes back 15 years, and you can see the delta position for the puts hitting levels that are unheard of, hitting the lowest level, or the most puts, I should say, in the last 15 years by far. Meaning people are prepared for prices to go lower. Typically, when that happens, we see the smart market go the opposite way. It's a contrarian view. I could pick out here. Back in January, what that was? That was COVID. And you see what happened there. Boom, it took off. There's been a few situations here when the market bottomed back in 23, it took off again. So when you have such high conviction out of people on one side of the market, here it happens to be bearish, typically stocks tend to go the other way. So regardless of everything I just said, this is more short-term stuff. We got to think big picture. We got to think about earnings because at the end of the day, stocks will move higher over time based on earnings because there's a valuation, and it's a very simple valuation, the PE ratio, the price over earnings. To keep that in line, prices go up. That's the top number. And then the bottom number is earnings. For that price to keep going up, to stay in line, we need earnings to increase. Here's S&P earnings going back to 2012. See, not much growth in 2012 to 2016, and we started growing a little bit. Then we had the great financial crisis where we came down. Then we went up, and then we had some COVID stuff happen. No, sorry, not great financial crisis. COVID, financial crisis was way back here. Then we had COVID happen and bounce back. But look at the acceleration we're really starting to see since we kind of bottomed here in 2023, 2022, 2023, taking off. The estimate, almost every number is in for last year, 274 a share, 313 this year, 363. So based on earnings per share estimates of 2026, the S&P trades around 21 times earnings. If you look next year, 2027, at 18 times earnings. That's not a number where you would say historically, let's rush out and buy, but it's nowhere near bubble levels. It's nowhere near overextended. And in a way that we're seeing growth on the bottom line and even the top line, double digits on both sides, it's very warranted to be trading at those valuations. But then within there, I'm about to show you in a second, this is much more of a stock picker's market to me. This is a market where you have to be able to pick stocks because within that, there are a lot of stocks that are bargains or some that are overvalued. So you have to do your homework. One thing to say before I jump into that, look outside the U.S. as well. Do not ignore outside the United States. And you can see here, this is a rolling 5-year return. So you take the return of the U.S. versus the world ex-U.S. index and do a 5-year rolling return. 15 years of outperformance. Had 12 years outperformance in the 90s into 2000. And then you can see how it switches. International takes over when reds. And I think we're on the cusp of that again. And I think international stocks, even though they had a good 2025, are still, as far as valuation is concerned, for the next 5 to 7 years. I don't say the better play. Index-wise, I think index will be better, but I think you have to be a stock picker. There's a lot of great U.S. companies, especially when it comes to innovation technology. We're leading. I don't care what anybody says. The United States is still the leader. But when it comes to just having pure valuation, solid companies, outside the U.S., there's a lot of opportunity. Everywhere from Europe, which is a mess politically in a lot of countries, but to Europe, to Latin America, Southeast Asia, I see a lot of opportunity out there. And in the McCall letter, we have quite a few stocks that are based overseas that trade in the U.S. as ADRs. You buy them just like any other stock. And some of our best performers, Swedish company, it's been around over 100 years. Italian cable company, one of the largest in the world, one of our big winners. So we look outside the box. Now, this is what I talk about. This is what is called the 97th percentile dispersion event. This is from Carlyle Group. And what they're talking about basically is how the dispersion between the top performers in the S&P 500 and the bottom performers in the S&P 500 is at the widest range that they've seen in a long, long time. And what that means, unfortunately, is that it's a stock picker's market. Those are 3 words I hate to say. I hate to hear people say them on CNBC or Fox News or wherever. I hate when people say it because usually it's not used in the right way. This truly is. I mean, it's always a stock picker's market if you're a good stock picker, but there's certain times you really have to look at it. And because AI is driving such rapid disruption, it's reshuffling winners and losers all the time. So you have to make sure. You could say, wow, this pullback in software is a great opportunity. I agree. But I wouldn't go buy the software ETF because there's a lot of stocks in there that I think are going to be completely disrupted and likely destroyed. There's a few stocks in there I think will come out on top and integrate AI into their business model and flourish. So you have to pick. Again, it's very tough. It makes index investing less effective. What's crazy right now is 57% of active fund managers that don't do an index actually are beating a benchmark this year. Average only 37%. That's why I say I never like mutual funds, because you got about a 1 in 3 chance of beating the market. You're hiring some woman or man or team, you have no idea who they are, never met them, and you're just looking at charts and holdings. You don't know what's going on in their life. You don't know what's going on when they're buying or selling. You have no idea. You don't have firsthand contact with them. You got a 1 in 3 chance, and you're paying them 1 to 2% to do it. It's the most ridiculous upside down backwards way to manage money. So mega cap dominance is breaking down. I saw a headline that said the Mag 7 is not a lag 7. So it's been breaking down. The market was driven, for about 4 or 5 years now by mega cap stocks. 2025, early 2026, we're starting to see that change. We're starting to see small caps, mid caps start breaking out. The others, as I like to call it, the 493 that aren't the Mag 7 outperforming. But again, I mentioned Mag 7 this week's holding up well. But the opportunity now expanding beyond the Mag 7 names gives you a whole new broad universe for stock pickers, which is fantastic. And active management is regaining relevance. And that's what we do here at the McCall Letter. We pick stocks. We're stock pickers. That's what I've been doing for 25 years, and I'll do until the day I probably die because I love it. Even if I'm retired, it'll be fun doing it sitting on the beach where I'm on the beach already, picking stocks. Because I tell you, there's nothing like finding the next big winner out there. So underlying all this, though, the breadth, which means how strong the market is, the foundation of the market, it is getting better and is leading to what I call a regime shift. And you're looking at 65% of S&P 500 stocks this year outperforming the index. So again, you'd rather pick stocks, you get a 2 and 3 chance of beating the market than just owning the market itself. This is a 97th percentile reading over the past 30 years. Again, dispersion. They're the haves and the have-nots right now. And think about this, from October 2025 was just a few months ago. At that point, we had breadth go down. This number was 25%. So we had a 1 in 4 chance of picking a stock that beats the index. That's when you want to be in the index. So leadership's broadening rapidly. Again, due to AI disruption. And some of it is emotional buying and selling in the short term. But again, I hate to use the baseball analogy because everybody uses it, but I think we're in the first inning of a 9-inning AI game, and it might be even extra innings. And we're going to have a lot of good innings and a lot of great innings and a lot of bad innings along the way too. Nothing goes straight up. And I think we're in a cusp of an inning where certain sectors are getting destroyed, software being one of them. And but within, again, that chaos, that uncertainty comes opportunity. This is just a stat I'm throwing there because I think this is very important. I just saw this came out today. I was just doing research. 401k millionaires hit new high. The average 401k account now has $146,000 in it. And I'm telling you this for a reason. I'll get to it in a moment. There's more millionaires than ever in the 401k, despite some volatility we've had last year. But keep in mind, the market was up double digits last year. S&P was up double digits. The mid cap was up double digits. Small cap double digits. Nasdaq double digits. But values jumped by double digits for the third consecutive year, which means people are actually holding on to their 401ks, not trying to trade it, investing long-term, which is fantastic, which is what they should be doing, in my opinion. IRA values, retirement accounts were up 7%. So the question is, how do you manage retirement accounts? Because a lot of people just put them in an index and let it go, there's nothing wrong with that. I'm not judging anybody. But again, we're entering a time where it's a stock picker's market, not for today, tomorrow, or this month or next year. I think for the foreseeable future. I think, we need to look at not only U.S., but abroad, as I mentioned. And I think you can create great portfolios like we do here at the McCall Letter based off different themes. The themes won't change. The players in the themes could change over time. And I'll talk about one of the portfolios I just launched recently, and I'll share a name with you in there that I think people aren't looking at. But I also want to put this out there because, as many of you know, I used to manage money. And I think I'm going to get back into it because I'm seeing so much opportunity out there. I want to share this with people, and I want to get back into the game and helping people create that retirement that they want. Not yet 100% full I'm doing it, but if anybody's interested, please let me know. Obviously, my old firm was Penn Financial Group. That wouldn't be the new firm. But it's something I'm debating back and forth at night and mornings, my walks on the beach, my hikes in the woods. So help me along here. If you're interested, let me know, because it's something that I think people need, especially these retirement accounts. You're sitting on loads of money. It has to be working for you. You worked your whole gosh dang life to make this money. Let it work for you. So if you're interested, let me know. Speaking of portfolios, this is one we launched on February 19th, just this year, obviously. So 2 weeks ago. And this was prices as of this morning. You can see in the time frame since we launched it, it's up 5.5%, but we do baskets. And you can see the S&P in the time frame is down 0.4. And 4 stocks, only 3 or 4 are up. So if we pick just one, you could be down. You can see the difference of how they've done. And I left one open because I wanted to share stock with you because I think this is an area that's very, very overlooked, and that's coal. And BTU is Peabody Energy, which you might have known from back in the day when people used to buy coal stocks. And I feel like nobody buys coal stocks anymore for whatever reason. They think they're killing the world with it or whatever it might be. But it's done pretty well for us, up over 6% in a short time frame, obviously crushing the market. But the theory behind this is, you'll see on the next slide, is here's a chart of coal prices on the right-hand side. Down today, down 5% or so today. But look at the spike that we had. This is the Rotterdam coal futures. Jumped from about 105 up to 140 intraday. That was a parabolic move. It's now since come down. But the thing is, you see these don't move much, and all of a sudden you saw major movement in the price of coal. Obviously, what's going on in Iran. It's a possible substitute for other fuels. And remember that a lot of the countries that rely on oil and gas, liquefied natural gas, LNG, out of Middle East, don't have supplies like the U.S. has. U.S. 20, 30 years ago was very reliant on the Middle East. Now, as I showed you earlier, produces over 20 million barrels of oil a day, number one producer in the world. So we're okay. But a lot of countries aren't. Asia and Europe rely heavily on LNG from the Middle East, especially Qatar. Pakistan receives nearly 100% of the LNG from Qatar. Bangladesh, India, majority LNG, same country. And BTU exports to Asia. China's another one. And China's not afraid to burn coal. India's not afraid to burn coal. Both countries are still building new coal power plants. Two of the most populous countries in the world, two of the largest economies in the world. They're not going to slow down. So coal, to me, could be a sneaky play here. Keep an eye on it. And I just added these. These are two publicly traded Chinese coal companies that trade in the U.S. as ADRs, which are American Depository Receipts. I just want to share with you to put that out there. Thanks for the comments there. More about money management would be see you back in the money management. Oh, thank you. I think I'm gonna get back in. It's one of those things, you look yourself in the mirror and you say, you're only good at a few things in life. And that's one that I'm good at. I enjoy it. I love talking with the people. I just love creating things. And it's something I think I will do. And you know what? I've got these suits sitting down here. I don't wear that often. I might want to get back out and start wearing those. So thank you. But again, if you have any questions here as we get closer to the end, please let me know. But BTU is one I think you should add to your watch list. Again, we have it in the portfolio going back here. You can see the new energy portfolio up about 5.5%. And again, these are all still buys, just to let you know. These are still buys here. If you join my call letter today, you can go in and buy these. I think it's still a great buying opportunity. And I'll tell you, this is made up of BTU. There's another one that is an Australian oil and gas company. So again, looking international, we always think outside the box. It's a company I'd likely 99.9% of retail investors in the U.S. have never heard of, but it's publicly traded here. You can buy it in the United States like everything else. We have a company that's kind of a supplier, if you will, to the oil and gas industry. And then we have another one that is a pipeline midstream company. So very diversified, 3 based in the U.S., 1 based in Australia. So we have a little international flavor in there as well. So again, I don't like to sell every time we do this, but we have to keep the lights on. I have employees I need to pay, et cetera, and I want to share what I do with everybody. So again, we always usually have it $298 a year, but when we do these live events, I like to get it down to $79 in the next 24 hours. So if you're interested, please let us know. Let's see. Thanks, buddy. Some nice comments in there. But if you have any questions, I also want to talk about this. So I launched that this year, called the Disruptor 25 Index. And there's other companies out there. Bespoke has one. Bespoke Premium I belong to. It's another kind of newsletter service. I think I pay $100 a month. So to give you an idea, I pay $100 a month for the information, and I maybe read it once a week, but I like it. And they have an index, the Bespoke 50, which is part of that $1,200 a year membership. Ours are only $79. The link's right there if you want to join. But the Disruptor 25 Index I started just because of ideas from a lot of other research I read. And I wanted to have a portfolio of 25 stocks that I felt really tracks the innovation, disruption that's happening in the world right now. Not just AI, a little bit of everything. So I put these 25 stocks together. I'm going to reshuffle them at the end of every quarter. So at the end of March, coming up in a few weeks, I'll reshuffle them. Year to date, this was as of the close of yesterday. It's up 2.8%. The S&P at that point was up 0.5%. And I don't think the S&P is really a great benchmark for it. So I have these other three benchmarks I'll stick with. And it's the Alps Disruptive Technologies ETF. That's down 5.2. The Granite Shears NASDAQ Disruptors ETF. That's down 11.5. And then the Fidelity Disruptors ETF down 2.6. Again, we're up 2.8. I'm not saying you judge how this is doing on 2.5 months. That's absolutely bananas. That's so short, time frame. I'm looking long term, but I will tell you, folks, it's pretty interesting to see how this has performed, because this next slide, only 10 of the 25 stocks are up, and we're still up almost 3% on it. All riding the big winner. It's about riding the big winners, because within there's a couple big winners. I mean, like 60, 70, 80% winners in there. That's what makes a portfolio. That's why you diversify. So long-term, we're riding the mega trends. In short-term, though, it's all about just kind of riding out this chaos and this volatility. And I'll give you three examples. One's Perpetua Resources, PPTA. It's a play in antimony, as I mentioned, also a play in gold. So you get a little bit of everything with that as far as precious metals and critical minerals. CME Group, the world's largest derivatives exchange, and also have some exposure to the prediction markets, which I think is going to be huge. And you have New Holdings, which is the Charles Schwab of Brazil. So there's 22 other ones in there. And I didn't want to just give this away for free. I didn't want to charge a lot for it. So I just added on, and a lot of our members are lifetime members. They buy forever. And lifetime membership, we're giving away right now for $298, $79 for the year, but lifetime for another $219, $298, and you get exposure to Disruptor 25 Index. The only way to get this. And you'll get the update that I'm putting out tomorrow morning on Disruptor. The monthly update goes out tomorrow. So it's even if you just look at it for ideas and pull from it, the updates each month, it's worth every penny. And again, folks, I pay $100 a month for a great research from this book. It's great, don't get me wrong. However, it's crazy. It's a lot of money. But again, for this, what's it? 79. I can't even do the math in my head. What is that? $8 a month? Not even. No, $7 a month, $6 a month, just over $6 a month. So yeah, you could do the math in your head. Let's see. Anybody have any questions? You could drop some questions in here now if you'd like. I'll take some as we do this, and I'm going to switch over here to my charting software so we can take a look at the markets and look at those charts I promised you that we would take a look at here. I can see myself in a camera here. It's amazing. I don't think I've wear a suit jacket in a long time, so you guys are privileged to see me in a suit jacket here. All right, so let's share this screen here with you and take a look at the charts, folks. Here's the S&P 500. We're at the lowest session right now. I have this CNBC on in the background there. I don't know why, it just distracts me, but just keep an eye on the markets in case anything were to happen. The headlines, Epstein files, crazy. But the market's down at 1.1% right now. But again, still only 2% off an all-time high. So it's not like we're getting crushed. It's still in this range. We're still in that very narrow range I discussed, which is about 2.7% range. Very narrow. This line I drew months ago. I drew this line back in, I think, October time frame, November. And this held up to be really good support. Because if you look, it's an important level going back here because you've held it a few times. Now, the thing is, could we pull back to there? Yeah. But again, folks, what we need to realize is even if we pull back to that level around 654, let's call it on the SPY, it's still only about a 6.5% pullback from an all-time high. We're not even in a zone right now of correction. Correction territory is 10%. And I think we could get a correction at some point this year. So let's see where that is, just to give you a number to keep an eye on. Because if we do go into correction mode, we're looking around what, 625 on the S&P. So or SPY, it'd be down here. That's going to hurt if it happens because a lot of individual stocks will move. But that's where we stand right now. I don't think we see this happen tomorrow, next day. Could it be a start of something? Sure. But I also think if the war ends or anything, it just kind of subsides, which the Ukraine war subsided very quickly. Granted, this is different. We're involved in it. But it becomes, investors become numb to chaos and uncertainty and major events quickly. More quick because we're so desensitized by all the bullshit on streaming and instant and social media and everything. So you're desensitized, so it does happen quickly. All right, let's take some questions here in a minute. I just want to look at a couple more charts first that I mentioned throughout. Here's a yield on a 10-year, up to 4.14 now on the 10-year. As I mentioned, it dropped below 4%. The first time we did that in months, just last week. And then we spiked on this. That means people are actually selling bonds, because as bond prices go down, there's an inverse relationship, yields go up. If you're buying bonds, yields go down, it's opposite. So here's the TLT, which is the ETF that tracks the 20 plus year. So as I just mentioned, coming down. So bonds have been coming down with stocks at the same time. Take a look at the US dollar. Here's a UUP, which tracks as an ETF if you want to track the US dollar, breaking out to a multi-month high. But it's really near a resistance level. It might actually, this blue line's a 200-day moving average. You got this price resistance around 27.5. It's trading right at 27.54 right now. So a little overbought on the RSI. Maybe it's time that US dollar comes down. It might be gold, might be good for silver. Silver, I'd stay away from. I called that a bubble, and I still think it's a bubble. I would stay far away from that. Let's take a look here. A question from Evan on SoFi. I love SoFi. I think SoFi is a great investment. I think it's a great long-term investment. Some of the financials, as I mentioned, have been getting hit, but when you look at fintech, I think it's just a great company. Last year, if I take a look at the numbers, reported earnings per share of 39 cents per share. This year is projected at 60. So that's about 55% year over year bottom line growth. Next year, 81. Next year, $1. So say we look out, I always want to be a 3 to 7 year investor at a minimum. So look out 3 years. Let's look to 2028, because this year, 6, 7, not 8. Projected $1 per share. It's trading at less than 19 times earnings off that. And it's obviously growing on average the next 3 years, about 35%. Top line sales expected to increase this year over last year, 29%. Next year, 23. Next year, almost 20. 2028. So this to me is a nice valuation. A company has rolled over. It's rolled over with a lot of the fintech stocks. And here's the FINX, which is a fintech ETF. Look at, it's been horrible, terrible. So this is SoFi has actually held up okay, all things considered, with its really kind of benchmark out there for it. So it's held up okay. I think down here it's a great buy. I think it's a great long-term buy. You let it go. I talked about Nubank that is in the Disruptor 25. So I'll show you a chart of that. This is, again, kind of, I call it the Charles Schwab of Latin America, really Brazil where it's based, but it's also expanding pretty rapidly into Colombia and Mexico. This is a company that it's going into a region of the world that's been so underbanked. People never had bank accounts. So now you suddenly have a bank that is, they call it like a neobank. No branches. I mean, heck, if you go to my JP Morgan, Chase, whatever it's called, bank, if I go back to the US, I can't get cash out of there anyway. It doesn't matter. There's no reason to have a damn office. So they don't have offices. Based on this year's projection of earnings per share, trading a P ratio of 17.8, even cheaper, expecting year-over-year growth of 44%. And then we take a look, next year's P ratio, forward P ratio 2027, estimate 13.5. Again, this is a company that's growing top line revenue this year, expected 36%. Next year, 22%. Year after that, 41%. This is a company, again, but think internationally. This adds some international exposure to your portfolio. These are all things that are often overlooked, folks. I got some more questions here. I'll take a look here. GENMF, he is Canadian, so it makes sense that it's a Canadian company. Well, I don't know the company. I'll tell you that right away. I think the chart looks fantastic. And I want to see real quick if they trade here in the here's a Toronto. If it trades in Toronto there too, as you can see. But this is a U.S. exchange, ADR, GENMF. I don't know. I got to tell you, short-term chart, he looks great. Long-term chart is obviously broken a long-term downtrend, moving higher. Again, I do not know much about the company, but let me take a look into it for you. That's why I'm here. So Generation Mining, put it into my system here. It's about, let's see how big the company is first. It's about a $173 million company, so it's tiny. This is a micro cap. Obviously, it's involved in mining, but let's see exactly what it does. It's an exploration development stage company, so looking for base and precious metals. They own 100% interest in a Marathon Palladium Copper project. I love the fact of having exposure to copper. Company's been around about 8 years. They also explore for tungsten, palladium, copper, platinum, gold, you name it. The thing is, this is when you have copper prices and gold prices going up, uh, rising tide lifts all ships, even if the company doesn't have much going on for it. I'm not saying this one doesn't, but obviously there's no projected revenue anytime soon from what I can see from this company. It was down around single digits, about 8 cents about a year ago. Now it's at 53. So it's gone up a lot. Hey man, ride it out. It's one of those high flying ones. But again, a copper company in North America, I love that. I think you want to have exposure to it. I prefer a few others that are actually making money already. This is too risky for me. But yeah, this is very interesting. Thanks for sharing that. Let's see here. Any thoughts on BTC, on Bitcoin? Yeah, I do have thoughts on Bitcoin. It's had a nice run as of late. I mean, it's selling off today with everything else because everything's pulling back here today. But I will tell you, it's had a nice run in the last kind of 48 hours. The thing is, I think it's going to continue to be volatile. I mean, we broke above. I'll show you the chart here of the IBIT just to give you an idea. This is one of the ETFs that tracks it. Kind of consolidating for a while there. We broke out, as I mentioned. This was yesterday's trading, down today almost 3% from yesterday's close in New York. And if it holds this level around 40, which is around 70,000 on the real Bitcoin chart, I think we're good. I think it looks nice there. I think Bitcoin is just trading like everything else right now. Some risk off assets, getting out of software. It's related to software a bit. I think a lot of people were concerned about this potential war. The war is here. Maybe it's not going to affect Bitcoin as much. I don't think the long-term thesis for Bitcoin has changed, in my opinion. So for me, I'm good. It hasn't changed, in my opinion, going forward. So could it hit, excuse me, 50 before it hits 100,000? Sure. I hope not, but it could. I still think we get to 6 digits, which obviously would be over 100,000 at some point this year, back above there. I think you have to be patient with it, and I'm fine with it. Somebody asked about tech resources. Let's take a look here. So another, obviously, more of an industrial play, pulling back from the high, but a lot of these companies have pulled back. This is, again, the pull back a little bit, then the war hit down today. But you take a look at a longer term chart of a company like tech. When you see here, this was a prior high back in 24. You break out, a lot of times you pull back. The resistance turns into support. And it's not perfect. It's not like, okay, this line, it's below this line right here. It's dead. No, that's so simple. Simpletons will ruin the world. You have to think a little bit outside the box. And I think there's great support right here. Could it pull back again to this uptrend line down here around 45? Yeah, it could in the short term. But again, it's in a sector and a trend and a theme that I really believe in. And you take a look at tech resources. It trades at about 21 times earnings this year, about 2.9 times sales. So it's not cheap, but it's not expensive. But again, it has exposure to a lot of the different minerals that I like, copper, zinc, you name it. And these are industrial metals that are needed for the innovation going forward. You wouldn't think it, but they're needed for the innovation going forward. RCAT, yeah, this is one I do like as well. This is one of the drone companies. I talked about drones yesterday in Market Insights and the daily. Again, down today. I mean, don't look at today because I hate looking one day, but down today. But it's held up very well. And look at a huge volume coming into it. This is an interesting play when it comes to drones. It's not kind of your direct play, but they do provide products and services to the drone industry. They have both hardware and software, so it's a little different than just a drone maker. So it has some software that goes with well, military, government, and some commercial as well. But the military government is obviously the real big thing. They have short range, medium range reconnaissance. They have the unmanned surface vessels as well. This is a very, very interesting company, because obviously this is the wars that the world is fighting right now are going more autonomous, and a company like this. And let me just show you real quick. There's 2 ETFs out there. Again, I'm not a big fan of ETFs personally in most situations, but there's a Rex drone ETF. Again, I talked about this yesterday. See, it's holding up well for the most part. And the other one's Jedi, that defines drone in modern warfare. Those are the two kind of recent drone ETFs that have been launched. Just looking, if you're looking for different ideas, and you know what, I will tell you what ETFs are great for, folks. If you're trying to find, oh, I want to know what drone stocks are out there, go to Jedi, go to drones, put it in whatever you want to use. You can go to Seeking Alpha or Yahoo Finance or Google Finance, whatever it is. Put in the symbols and look at the top holdings, or Google their website, look at top holdings. It's going to be drone companies. And it's a good way for you to start looking and kind of getting ideas if you don't know where to look for drone companies. Granted, we have ChatGPT and everything these days, but sometimes it's better to do that. So I would definitely never ignore that. But again, folks, drop me more questions. I'll take them if you have them. But again, I always like to thank everybody for taking time out of their day to show up, because I do know it's important to do this, but I also know that everybody has busy schedules these days. But again, I would love to have you all join if you're not yet members. I mean, again, it's only $79 for the year. I think it's worth every minute. And if you're already a member and you're not lifetime, shoot us an email at info@nextwave research. We'll get you set up with the lifetime, because then you get exposure to the Disruptor 25 index, which again, I update every month. And then rebalance it and add new stocks, take some out every quarter. At the end of March, we'll be doing the first rebalance. So you get new stocks coming in, which is great. Stocks coming out. You get your monthly update in about next 24 hours. So you got everything new coming out. And I will tell you too, for the McCall letter, I have 2 new portfolios that I'm getting ready to launch. And both pretty interesting. One is a fintech. So there's going to be 3 fintech stocks in there. Another one is going to be related to SpaceX. Several plays, 4 different investments of ways to invest in SpaceX now, because I think it's going to go public at close to a $2 trillion valuation later this year. And I think you want to be in now, because I think there's a lot of upside potential. So 2 new portfolios being added to the McCall letter. So if you join now, you get those for free when they're launched. I'm just finalizing them right now. So again, we'd love to have you join. But again, folks, thank you so much for taking time out of your day. I'm going to let you go, get back to your day, get to lunch, finish it up, whatever it might be. Maybe you're wrapping up work for the day. If so, enjoy it. But again, there's a couple of things. Love to have you to join. Yeah, somebody just said we need a SpaceX pre-IPO. Well, if you remember McCall letter, you'll get all of it. There's 4 different investments, all different ways to play SpaceX. A whole report. I just finished a report yesterday. Just finished it yesterday. I'll take one more question just because why not? It's on some aerospace defense stocks. And it looks like Lockheed Martin and Raytheon. Excuse me. So Raytheon RTX Corp, they call it now. I mean, even before what's going on with Iran, Middle East, I mean, you can't find a better chart in the market, honestly. I mean, it's just a great looking chart. RTX, I think it's a great long-term hold. Yeah, it's down today, and I think it could pull back a little more. It could have pulled back to the 180s, 185. Sure, at that point, I'd be an aggressive buyer there. If you own it, I wouldn't touch it. I'm just saying if you want to try to get neat with it and pull back, I think it could pull back a little bit more, because it hasn't had much of a pullback again over the last year or so. But this, I can't remember what it's called. It's not Shock and All. Epic Fury, I think it's called. I mean, the amount of munition and planes and just aerospace defense products and services that are being needed. RTX is involved in drones, obviously, as well. We're using a lot, but the U.S. Military, and we're not going to stop anytime soon. It doesn't seem like. We need to replenish. So a lot of these aerospace defense companies have moved on that, but I think defense spending increases even more than any of us can imagine in the next couple of years, especially under the Trump administration. So I think these companies will do really well. Lockheed Martin's one that I really, really like. Pretty similar chart. It was kind of went sideways, so it broke out, started running in December, hit an all-time high just 4 trading days ago. But again, pulling back, no big deal. I think they're both great long-term buys at these levels, and great long-term holds as well. So, but again, folks, thank you so much, and love to have you to jump in and join. I think, at this point, it's a opportunity for you. So I would love to have you join a family. Again, you're getting all that new stuff. Thanks. And somebody said, thanks for the comment. Nothing better than getting comments back. Honestly, I think that's great, and that's why we do this. And I tell you, this business, people think you sit back and when I get to go to the beach when I want and write when I want and do what I want. I'll tell you, my team and I, we're working our effing tails off right now because it's a new company just to try to, I got to keep the lights on. I got to pay the bills because it's not free to do all this stuff. It's not free to advertise. So I'm not looking for a pat on the back. I'm just telling you, we're doing this out of the goodness of our heart right now. But yeah, we are here to make money, but we're doing this and we're working our tails off to get to where we need to be. And in the meantime, give you some great freaking information along the way. So I'm excited to launch 2 new portfolios in the next 2 weeks. So look out for those. If you're McCall members, if you're not yet a member of the Lifetime, join us now. Send us an email at info@nextwaveresearch.com. We'll get you up to rate at the Disruptor 25. Everybody else, hey, you stop in for free every couple of weeks, and thanks. Keep stopping by. You're more than welcome to join us at any time. But again, thank you all so much. I hope you have a great rest of your Thursday afternoon, and we'll see you soon. And again, remember, with chaos and uncertainty comes opportunity, and McCall letters, they're waiting to help you along the way. For everybody here at Next Wave Research, I'm Matt McCall. Thank you very much.